Hello, good evening everybody. Let us come to the quick revision of super fast revision of financial reporting topic IND AS 103. What is IND AS 103? It is business combination. This is one of the very important standards for your examination, and all of you must do it thoroughly, because you can expect a question of around 15 to 20 marks on this topic, and usually they ask a question on this. So we are going to discuss all the important principles of IND AS 103. So this is a super fast quick revision. I am going to give you complete guideline on how to solve different types of questions. So kindly pay attention. If you want to get the maximum benefit of this lecture, then you can purchase from our website on which this presentation is designed. This book is called Financial Reporting Compact Book. It covers the entire syllabus in simple words, in very easy to understand format. Anybody can understand it. Institute module has a lot of complicated paragraph statements. They don't give you things very nicely, properly. So in this book, what we have done, we have presented the chapter, you can see, in a very simple manner. So you can revise it one day before the exam. The whole syllabus you can revise in just few hours. So I would highly recommend that you purchase this book FR Compact from our website vino.in. This contains theory, only theory, and step-by-step presentation and solution that you need to follow, but this does not contain question answer. If you want question answer also, we have this another book called FR Compiler. You can purchase FR Compiler from our website vino.in. It contains question from study material, RTP, MTP, past exams. So this will be very useful. This combination of compact and compiler will be very useful for your FR preparation, for whether you are a CA final student or CMA final student. So first we will start with the introduction of business combination. This is a very wide standard. It covers many aspects of business combination. It covers mergers and acquisition. It also covers accounting for consolidation on the date of acquisition. What about subsequent accounting? The subsequent accounting will be taken care of by IND AS 110. But on the date of acquisition, the accounting of consolidation is done as per IND AS 103. Then it deals with accounting of business, which may not be a subsidiary. You may just acquire a business, and it is also covered by this standard. This accounting standard also deal with common control transaction, including demerger, highly tested in your exam, and all this we are going to discuss in our today's lecture. This is our agenda. What about asset acquisition? If it is not business combination, if it is just asset acquisition, it is not covered by the standard, but this standard gives you some guidance on accounting of asset acquisition. Common control transaction is not covered by IFRS 3. International standard IFRS 3 does not have common control transaction. So accounting of common control transaction covered by IND AS 103 is a carve-in, is a major difference between our standard and IFRS. So one carve-in you will learn in IND AS 103. Now we'll come to first thing first, meaning of business combination. Hello to everybody who has joined our live session just now. So meaning of business combination. What is business combination? Meaning of business combination is a business combination where acquirer obtains control over one or more businesses. Acquirer obtains control over one or more businesses. Who is an acquirer? One who acquires control over the other business. What is the meaning of control? This is covered in IND AS 110. Your definition of control is covered by IND AS 110, and the meaning of business is covered by this standard. Control is covered by 110. Acquirer means the entity which obtains control. And what is business? The definition of business has undergone change by an amendment in IND AS 103 on 24th July 2020. Now the meaning of business is, it is a set of activities. It is a set of activities which qualify business assessment test. It is a set of activities which qualifies business assessment test. So we will call it BAT, business assessment test. Hello to everybody who are joining the live session. Hello Rahul, hello Amol. Now next is, what is the meaning of business? So let us quickly just go through some theory part as an introduction, and then we'll see what kind of question they will ask you in the exam. So are you ready? If you say yes, then I will go further. Say yes. Business means an integrated set of activities and asset. Today is a super fast revision batch, so we'll not have time to discuss each and every line item, but still I will try my best that in the given time slot we can complete the entire chapter. So it is an integrated set of activities. The set of activities and asset which work together. The set of activities which works together, capable of being conducted and managed for the purpose of producing goods and services. So this is what we generally know as business, set of activities which help us in producing goods and service. But this standard of business also includes or for investment purpose or investment income. Not just producing goods and service, set of activities can be used for earning investment income like dividend and interest. So there can be a company which may only be providing investment service, portfolio service, or from other income from ordinary activities. So this is the meaning of business, integrated set of activities for producing goods and service, earning income or any other income from ordinary set of activities. Now let us see what are the elements of a business. So business has three elements. Business has three elements: input, process, output. But please remember, output is not a necessary condition. So first we will see what is the meaning of input. What is the meaning of input? Input are economic resources which have ability to create output by applying one or more processes. So if there are raw material which can be processed and converted into finished goods, that is input. In a coaching organization, we are the inputs. Okay. Then inputs will include assets and workforce. Which kind of assets and workforce? Skilled and special workforce are included. Not all workforce need to be skilled. Assets will include PPE, intangible assets. Other assets and liabilities are not inputs. Input will include your workforce and certain assets like PPE, intangible asset, but other assets and liabilities are not inputs. What is process? Any system, standard, protocol, convention or rule that when applied to an input or inputs creates or has the ability to create output. So processes are applied over input to create output, like production process, okay, manufacturing process, whatever. They depend on type of business, the process can vary accordingly. The processes typically are documented. That is, the organization will make a list of the steps that is followed. but an organized workforce having necessary skill and experience, following rules and convention may provide the necessary process that are capable of being applied to input to create output. So it is not always necessarily documented. A set of skilled workforce, when they apply certain rules and convention on the input, it is capable of creating output. Now please note down what is not process. Accounting, billing, payroll and other administrative system are not processes used to create output. But of course, if your business is to provide accounting service, business is to provide payroll services, then they will become processes. And what is the meaning of output? So output means the result of input and process applied to those inputs that provide or have the ability to provide a return in the form of dividend, lower cost or other economic benefit to the investor or other owners. That is called output. Now please double underline or note down, remember, output is not a necessary condition for qualifying as a business. So for example, a research division can qualify as a business even though it may not be producing output right now, but it has the capability of producing output in future. How to identify a set of activities acquired by acquirer is a business combination. How to identify whether the set of activities acquired is a business combination, because if only it is a business combination, then the standard is applicable, but if it is an asset acquisition, then the standard is not applicable. So here what we'll do, now this is an amendment in 2020 in the definition of business and how to identify whether a set of activity is a business or not. So they have said, you first step 1, apply optional concentration test. Optional concentration. Optional means this is not mandatory, you can apply it. If this test is satisfied, then it is an asset acquisition. We will discuss it in the next slide. First, apply optional concentration test. Whether majority of your payment that you are making consideration is for one or a group of assets only. If that condition is satisfied, we will call it asset acquisition. If that condition is not satisfied, then you go to step number 2. What is step number 2? Apply business assessment test. We will discuss again because that is very important for identifying whether a set of activity is a business or not. If the entity has not applied optional concentration test, as I said, this first step is optional. If you don't apply optional concentration test, then directly start with business assessment test. So what we will do in business assessment test, under business assessment test, you have to check minimum one input. Those who have our compact book will mark it minimum one input plus you have substantive process that have the ability to create or produce output. If set of activities does not produce any output, as I said, output is not necessary, but it should have the ability to produce output. If the set of activities does not produce any output, it is possible the set of activity right now is not producing output, then check process is critical to ability to create output. So sometimes you acquire the research division. That process may be so critical that it is required to create output. Plus, you must also acquire organized special workforce. The process must be critical to create output, plus the people who are managing that. Just visualize a research department where scientists are sitting. They must also be acquired along with resources needed by such workforce. If this is satisfied, then we will say this integrated set of activities is a business. If set of activities produce output, first was does not produce output. If set of activities produce output, then what we have to do? Then we have to check process is critical to ability to continue producing output, plus organized special skilled workforce is acquired along with the resources needed. This is the same as the previous one, or the process is unique. Process cannot be created unless substantial time and cost is involved. So that process is either unique or it will require substantial time and cost. So if you want to create a similar business, it will take a lot of time. If you want to create another Reliance kind of business, it will take huge amount of time, huge amount of expenses. If these conditions are satisfied, if it is not producing output or if it is producing output, then this set of activity will be called as a business. Otherwise, it is an asset acquisition. Now the next question is, what is concentration test? Concentration test means, are we paying the purchase consideration only for the set of assets or not? If you are paying only for a set of assets, then it is asset acquisition. So let us see how to apply concentration test. Important for exam because it was an amendment in year 2020. So if you are reading from old book, old coaching, then you will not find it. So first you calculate the fair value of the interest acquired. Fair value of the interest acquired, plus you also add, first we will calculate fair value of interest acquired, which is equal to non-controlling interest. NCI means non-controlling interest plus consideration transferred in set of activities acquired. So this is what you have paid and this is the value of NCI. So if you have acquired 80%, this is 20%. So total is you are actually paying 100%. What you paid plus what is the value of the non-controlling interest in that business. Then you calculate the fair value of the asset acquired. Fair value of the asset acquired is equal to fair value of the consideration plus add fair value of the liabilities minus the cash and cash equivalent acquired. If any cash and cash equivalent is there which you acquired, you please deduct it. So this is the fair value of the asset acquired, what you paid plus also the liabilities that you assumed minus any cash. Now just note down that do not include deferred tax liability in the above liabilities. In the liabilities, deferred tax liability will not be considered because that is only a book entry. That is not a liability actually payable to the government. Then identify single identifiable asset. So if in the balance sheet you have PPE which is 900 and other assets 100. So this is a single identifiable asset or similar group of asset. This is 900. Fair value of the singly identified asset and fair value of the asset acquired as per previous step. Let us say 1000. So this comes to 90%. So 90% of your consideration is just towards one single asset. Then we'll say concentration test is qualified. If 90% or more of the consideration is for single asset or similar group of identifiable asset, then it is a concentration test satisfied and you will follow asset acquisition. Then will follow asset acquisition. Now I'll tell you again, this standard does not deal with asset acquisition, but some brief guideline is given as to how are you going to do accounting in case of asset acquisition. So only one or two paragraphs we will discuss on asset acquisition. So those who have joined late, please refer our FR compact book for better understanding. Everything is written in this book in the same way, line by line, very useful for understanding of your CA final or CMA final FR. 1 hour you can revise the entire business combination chapter. And for numerical question, you can practice from our compiler, FR compiler. You can get it on our website vino.in. So let us come back to accounting for asset acquisition. Some guidance is given in IND AS 103. So we'll pass the following journal entry. They can ask you a question on asset acquisition also. So what you do, you will pass the following journal entry. Revalue asset. Those assets which are taken over by the acquirer, you revalue asset transferred as a part of purchase consideration through P&L account. One student is asking a question, why P&L account? Why not revaluation reserve? The answer is, you are selling that asset in a business combination, so therefore those assets which you are going to sell and acquire a business, so indirectly you have realized those profit, and therefore the entry will be asset account debit to profit and loss account. In case there is a loss, P&L account debit to asset account. You have transferred certain assets and you have acquired another company's business, but it is not a business combination, rather it is an asset acquisition. So this asset which we are transferring, those will be revalued and the profit will be transferred to profit and loss account. Then you will record the assets and liabilities acquired. Assets account debit 1, 2, 3, 4 to liabilities account, whatever number of liabilities you have acquired, to consideration paid in the form of cash, to consideration paid in the form of assets, to consideration transferred in the form of share capital, and to bank any acquisition cost. And this way assets and liabilities acquired in an asset acquisition will be recorded. So some important notes I will give you. Keep in mind, very useful for solving question on asset acquisition. The question the student can ask is, suppose one lump sum amount is paid and you acquired many assets and liabilities. You paid 10 crore rupees and you got assets and liabilities. How do I allocate this 10 crore rupees? So the answer is, allocate consideration plus acquisition cost. Because it is an asset acquisition, the acquisition cost will be capitalized over the assets and liabilities acquired in the ratio of fair values. In case if you find that some assets are impaired, because of this you will apply IND AS 36 impairment and bring it down to their recoverable amount. Do not record any goodwill. Why? Sir, in my 12th standard they taught us to write difference in goodwill. 12th standard is over. This is asset acquisition, not business combination. So do not record any goodwill. Do not record any deferred tax asset or liability due to change in fair value. Cost of acquisition. Some questions are coming. Why cost of acquisition is capitalized? Cost of acquisition is capitalized because it relates to PP acquisition under IND AS 16. Remember, what I am telling you right now is the accounting of asset acquisition, not business combination. So this was about asset acquisition. Our remaining discussion is on business combination. The method of accounting that is used for business combination as per Ind AS 103 is called acquisition method of accounting. Okay, so usually I will first tell you the basic entries that we pass in case of acquisition accounting. Following entries will be passed in the books of acquirer. This standard deals with accounting in the books of acquirer. So on the date of acquisition, we will write business combination account debit, agreed consideration. The amount is equal to agreed consideration to the acquirer or vendor. Actually, it should be acquiree. To the acquiree or vendor, being business acquired. First entry, business combination account debit to vendor account. Second entry, you will record the assets and liabilities taken over at fair value. Sundry assets account debit at fair value, to sundry liabilities at fair value, and to business combination account as per the previous line. If there is a difference on the debit side, goodwill will be debited. If there is a difference on the credit side, gain on bargain purchase account, which is what we call capital reserve. Capital reserve, gain on bargain purchase or capital reserve account credit as a balancing figure. Now what about the presentation of gain on bargain purchase? If in the above entry we get gain on bargain purchase, then review the fair value and process of calculation including non-controlling interest. Is it right? Generally in business combination you will get goodwill because somebody is valuing business, so therefore usually they will pay a higher amount, but it is quite possible due to some reason the person who is selling his business may sell it at a lower price. So in that case the standard says you again check whether all the process that was used to calculate the fair value, the non-controlling interest are correct or not. If after your review you find that the condition of gain on bargain purchase still exists, then it should be first transferred to OCI. It should be first transferred to OCI, and from OCI it will be transferred to capital reserve. Then it will be transferred to capital reserve. But sometime we are not able to satisfy this condition, that after review also we are not sure that it is still capital reserve. Then the answer is directly you transfer to capital reserve in SOCIE. If you think all processes have been correctly applied, then you transfer it to OCI first. Otherwise you transfer it directly to capital reserve in statement of changes in equity. Now if business combination is of entity, suppose you acquired another company, then such acquisition is less than 100% of ownership, which is usually asked in your exam, that a company acquired 80% share in other company. What about the remaining 20%? The remaining 20% will be treated as non-controlling interest. Non-controlling interest will also be recorded on the date of acquisition. More about NCI in Ind AS 110 coming soon. Then come to the payment of consideration. The consideration payment entry will be vendor account debit to share capital, to deferred consideration, and to contingent consideration. This again we will discuss subsequently. Some consideration may be paid at a future date, that is called deferred consideration. Some consideration may be paid subject to fulfillment of some condition in future, that is contingent consideration. Now, one thing which your study material of institute does not write properly, but we have made a very good summary on that. I hope you will like it. What are the types of business combination for accounting purpose in the exam? This is something really useful for you. See the question and you find out whether it falls into which of the type of business combination we are discussing. Accordingly pass the entry. Is it right? I request all the students to subscribe to YouTube channel. Please subscribe immediately. Click on the subscribe button of our channel AS Foundation. And also please click the like button. This will motivate our team to work hard for the benefit of the student. Okay. And also share with your other CA or CMA final student, because many students, they are not aware that we are conducting this super fast quick revision batch. So requesting all of you to kindly like, share and subscribe to our YouTube channel. I'll be very happy. So let us come to accounting in the books of acquirer. Accounting in the books of acquirer. Now what are the types of question they will ask you? Pay attention on this case number. So I will take 4 slides for 4 cases. First, case 1. B Limited acquires 100% of shares in A, and A Limited becomes subsidiary of B. So it is a case of 100% acquisition of share in another company. Then you will find there are 2 entries, one on the left side, one on the right side. In the left side, the entry in the separate financial statement, and on the right side, the entry is in the consolidated financial statement on the date of acquisition. So in separate financial statement, if you acquire shares in a subsidiary, then you just pass the entry investment account debit to bank account. But in consolidated financial statement, what we'll do, we'll pass the entry identifiable net asset acquired at fair value, means assets account debit, liabilities account credit, goodwill will be balancing figure. Any goodwill appearing in the books of acquiry, you don't write it. Let the goodwill be the balancing figure here. Then to investment. Suppose you have acquired less than 100%. Suppose you have acquired less than 100%, then you will credit non-controlling interest also. If you have acquired 100% interest, then there is no need to write non-controlling interest. If you have acquired less than 100%, then you have to write NCI. What about the accounting entry for post-acquisition changes? Further accounting in consolidated financial statement will be covered by IND AS 110. Now please focus here. Case 2. B Limited acquires 100% of A. A Limited closes down. That is, it is merged with the entity B. In the first case, B continued as a subsidiary. In second case, A Limited is merged with B. A Limited absorbs B. What we used to call in intermediate absorption. B Limited continue to exist. So only the acquirer will exist. Acquiry will be closed down. Acquiry will be closed down. Like for example, SDFC Bank will acquire SDFC Financial Institution. Only this will continue. This will close down. SDFC Financial Institution will close down. In that case, this set of entries will be passed. So first I'll come to SFS, separate financial statement, business combination account debit to vendor account, identifiable net asset account debit, goodwill account debit balancing figure to business combination account, and then vendor account debit to bank account, vendor account debit to bank account, depending on what kind of the mode of payment you write. So to bank or to cash, to asset, whatever. And in case of separate financial consolidated financial statement, pay attention. Now because the subsidiary is not there, there is no question of consolidation. Whatever figures we have written in SFS, the same figures will continue in CFS also. There is no entry for post acquisition change. NCI will not be there. This was my case number 2. Now we'll come to case number 3. This is also important. Suppose a company A has 3 divisions, B1, B2, B3. Okay, B1, B2, B3. Then another company B Limited acquires division B2. Only a division is acquired. The whole company is not acquired, but a division is acquired, and that division B2 meets the definition of a business. So in that case, the entry in SFS will be same: business combination to vendor, identifiable net asset, goodwill account debit balancing figure to business combination, and make the payment with vendor account debit to bank. In consolidated financial statement, there is no extra effort required because we have not acquired a subsidiary. Same figures will be used in CFS also. No need to pass post acquisition change entries because there is no subsidiary. No question of NCI. Now case 4 is on demerger. Highly tested in the exam. Double tick mark. Highly tested in the exam. Now there is a company A, 3 divisions, B1, B2, B3. Now they will say B2 is demerged. B2 is demerged and a new company will be formed, to which the assets and liabilities of division B2 will be transferred. This situation is called demerger. A Limited is called demerged company. New company B is called resultant company. What about the accounting? Accounting of demerger we'll discuss towards the end. So kindly watch this video till the end. You'll be benefited. Now we'll come to contingent consideration. Under Ind AS 103, the consideration paid will also include contingent consideration. Contingent consideration means payable to the shareholder depending on certain future condition, depending on satisfaction of certain outcomes in future, then it is payable. That is why the term used is contingent. It is dependent on some future event. Contingent consideration is payable to the shareholder without condition to remain in employment, and it can be in the form of cash or it can be in the form of equity. Consideration can be paid only in the form of cash, and consideration can be paid in the form of shares. Now the question is, what about number of share? Number of share can be fixed or number of share can be variable. So if number of share is variable, you have studied in a standard on financial instrument Ind AS 32 that it is a liability. So therefore, if the contingent consideration is payable in cash or payable in number of share which is variable, it will be treated as a liability. Okay, how it will be measured? Initially measured at fair value. On the date of acquisition, fair value. What about subsequent change? Fair value. Change in fair value will go to P&L account. Settlement will be made as specified, either in cash or in the form of number of shares. Other possibility is that contingent consideration can be paid only in the form of equity share in fixed number. So you have seen in IND 32, if equity shares are issued in fixed number, then we call it as equity. Initially recorded at fair value. But subsequently, if contingent consideration is payable in the form of fixed number of equity share, very important, it will not be remeasured. You can get a 4 mark or a 6 mark question from this paragraph, and accordingly you have to do the accounting. Upon settlement, any difference, if any, will be adjusted directly in the statement of changes in equity. Now I am going to tell you something very important, how to calculate purchase consideration for business combination or agreed consideration. What are the items you will add and deduct? So I request you to kindly pay attention to this very important table, not given in your ICI study material, but very useful. All your basic calculation of purchase consideration will fit into this format. So first what you will do, you will add fair value of any asset transferred. It can be cash, it can be any other asset like land. If any share is issued, we'll take fair value of the share issued. If there is any deferred consideration, we will take present value of deferred consideration. So this you will add. If there is any contingent consideration, that also will be taken at fair value. Now, confusion. Deferred consideration will be at present value. Contingent consideration will be at fair value. Contingent consideration will be present either in non-current or current liabilities depending on when it is payable. Then we will take fair value of contingent consideration payable in equity shares. So it can be payable in cash, then point D, payable in fixed number of equity share, point number E. Then there can be value of share based payment award also. The acquirer company may agree to issue shares to the employees of the acquiring company. So this I am going to discuss after some minutes, how to do the calculation of this, highly tested in your exam. So then we'll take a total of point number A, B, C, D, E, F, that is consideration. So usually you will get adjustments up to this only, but there can be some additional adjustment for separate transaction cost, STC, separate transaction cost. Now what is STC? It means there can be some outstanding receivable or payable between acquirer and acquiree. Acquirer may be a debtor, acquiree may be a creditor, or acquirer may be a creditor, acquiree may be a debtor. So all those pre-existing relationship will also be closed. So in that case we are going to make adjustment. So if any asset is written off, we will add, and if any liability is cancelled, we will deduct. This will give me purchase consideration for business combination, PC for BC, PC for BC or agreed consideration. Now a small discussion on reacquired rights. Reacquired rights. A has given rights to B, like license, brand. Now B is acquired by A, so these rights are also acquired by A. What is the treatment of reacquired rights? These are the rights which the acquirer before acquisition may have granted to the acquiree to use certain asset which belongs to the acquirer, like a trademark, for example license, brand, franchisee rights. So now this pre-existing relationship will be cancelled, and any settlement gain or loss, will be treated as a separate transaction because it is settlement of a pre-existing right, it will be treated as a separate transaction and will be recorded in the financial statement of the acquirer. So contingent consideration, I want to discuss something more because institute has given lot of situation here. So first is, a contingent consideration can be payable to a shareholder who is also an employee. Shareholder who is also an employee, and condition of contingency is to remain in employment. Condition is that he will remain in the employment apart from other condition. So now what our standard says, this is outside the scope of 103. If the condition is that a shareholder who is also an employee will remain in employment, is outside the scope of the standard, it will not be a contingent consideration as per IND AS 103. It will be dealt by other standard. For example, it will be dealt by either IND AS 19 if it is a non-share based award, or it will be dealt by IND AS 102 if the consideration payable is in share to employees who are also the shareholder. Case 2, contingent consideration is payable to employee who is not a shareholder, and the condition is to remain in employment apart from other condition. Now again the standard says, if the condition is to remain in employment, even if you are not a shareholder, it will be covered by either IND AS 19 or IND AS 102. So in both cases, if the condition is to remain in employment for a certain number of years, any payment to be made will be covered by IND AS 19 or IND AS 102. Case 3, contingent consideration payable to the shareholder without condition to remain in employment. So if there is no condition of employment, it may be contingent on some other condition. It may be contingent on profit, market price target, market share target, EPS target. Then as we discussed earlier, if it is payable in cash or variable number of share, it is liability. Record at fair value, change in fair value P&L account, settlement will be made as specified. If payable in variable number of share, it is treated as equity, recorded at fair value, subsequently not remeasured. Upon settlement, directly it will be adjusted in SOCI. So this I think we had covered earlier also. What about acquisition related cost? Lot of legal cost, administration cost, brokerage, investment bankers fees, printing and stationery, etc. are incurred. If it is a business combination, all acquisition related cost will be transferred to P&L account except cost of issue of debt or equity. Except cost of equity or debt issue. Now we have seen it will be covered by IND AS 109, because in IND AS 109 cost of issue of equity is not adjusted in P&L account, but it is adjusted in SOCIE. Now another highly tested area is treatment of share based award. Treatment of share based award already issued by the acquiree. A has acquired B. B has given share based payment award to the employee. B is acquired by A. What will happen to those SBP which is promised by B to its employee? So if the acquirer, this company A may say, don't worry, we will give you our share. Or we will make some modification in the existing SBP only. So if issues new award which are in the nature of replacement award or which are amendment or modification to existing award, then we'll follow the following steps. Pay attention. Highly tested in the exam. If the acquirer company issues share-based payment award which is held by the employee of the acquiree, how you will deal with? So first you calculate the value of award to be included in purchase consideration. How much of that SBP award will be forming part of purchase consideration? So the answer is, we will calculate the fair value of that award to be included as a part of PC equal to fair value of original award, that is the award which were given by acquiring company on the date of acquisition. Fair value of original award on the date of acquisition multiplied by expired period, that is how many years are already over, divided by original vesting period or revised vesting period, whichever is higher. So fair value of original award, suppose 200, period expired 2, original vesting period was 4, but the revised vesting period is 5, so I will divide by 5. But if original vesting period is 4, revised is 3, I will take 4. So this amount will be forming part of purchase consideration, which I had shown you in a table, share-based payment award. But if some more years of services are yet to be rendered, then there will be post-combination service cost. Post-combination service cost will be dealt as per IND AS 102, and the calculation will be fair value of the amended award or replaced award on the date of acquisition. So here I will take fair value of the replaced award, new award on the date of acquisition, minus value considered in purchase consideration, previous step 1. If this formula gives you an answer 200 rupees for example, and this is suppose 400 minus 200 already considered, remaining 200 will be treated as post service combination service cost, and it will be allocated over the remaining vesting period in the post combination period. So that was about SBP award. Now very important, recognition and classification principle for identifiable net asset. Are we going to recognize all the assets and all the liabilities that are appearing in the books of acquiree, or can we re-evaluate whether these assets and liabilities fulfill the recognition criteria or not? Second, are we supposed to follow same classification or we are supposed to follow a different classification? So the answer is, when you are recognizing assets and liabilities acquired, in case of acquisition accounting, we have to check whether they meet the definition of asset and liability on the date of acquisition. If they meet the definition of asset and liability on the date of acquisition, then we are going to record them at fair value. So first they should meet the definition of asset and liability recorded at fair value, but there are some exception. There are some exception on the recognition and measurement. So we have to keep in mind some recognition and measurement exception, very important for exam. Your institute will check your knowledge on every line item. So if you have acquired any asset in business combination but you want to sell it, so this is called asset held for sale. In that case, we will not record it at fair value, but we will record it at fair value less cost to sell. Fair value less cost to sell. If you have some employee benefit like gratuity provision, then that is recorded as per IND AS 19. If you have any leased asset or lease liability, then they will be recorded as per the value given in IND AS 116. One important query is on contingent liability. Since the students are highly talented, they are well aware contingent liability is not shown as a liability in the balance sheet, but contingent liability is disclosed. So there can be contingent liability in the books of acquiree. Can we record it as a liability in the balance sheet of acquirer? And secondly, can we record indemnification asset? This is indemnification asset, my mistake. Like there may be some liability in the contingent liability in the books of acquiree. There is a court case going on, and then that we are not able to decide whether we should acquire this company or not because of the ongoing court case. The acquiring company says, don't worry, if you incur any loss, we will indemnify you. We are going to compensate you. So then that is called indemnification asset. First question is whether contingent liability of acquiree will be recorded. So this is an exception. This is a very important exception. Contingent liability would be recorded if two conditions are satisfied. They can ask you in your interview also in future. First is there must be present obligation arising from past event. There must be present obligation arising from past event. And second condition is its fair value can be measured reliably. Then this contingent liability will also be shown as a liability in the books of acquirer. So condition is there must be a present obligation arising out of past event, and second is whose fair value can be measured reliably. Should we record indemnification asset also? So Mr. Rathi is saying that yes, we should record indemnification asset also. So indemnification asset will be recorded at fair value on the date of acquisition, but the amount recognized for indemnification asset will not exceed contingent liability recorded. So if contingent liability recorded is 50,000, the maximum amount of indemnification asset will be 50,000. So this also you mark as important. Now next is classification of asset and liability acquired. Classification. Can we change the classification? Can we change the classification? Is it necessary to follow the same classification? The answer is we can change. Usually the acquirer may follow the same classification, but the classification can change on the date of acquisition depending on facts and circumstances. So acquirer is free to change the classification. Example, there may be some asset which were used by the acquiree, but the acquirer wants to sell it. So in that case, those assets will be classified as held for sale. Second example, there may be some investment which may appear at FVTPL, but the acquirer may decide to treat it as FVT OCI. So one Mr. Mohammed said, no, we can't change the classification. You are not right. We can change the classification in the books of acquirer depending on facts and circumstances. Okay, you can change. Next exception, where acquirer cannot classify on its own. Now here you have to keep in mind, they have given two situations in which you cannot change the classification. Which are these two exceptions? The exception number one is where acquiree is a lessor and classification is made as finance lease and operating lease. So if the acquiree, who is a lessor, has classified a lease as finance lease, you will also classify the lease as finance lease. If the acquiree has classified a lease as operating lease, you will also follow the same classification. And second is not very important for our syllabus, insurance contract, IND AS 104. What about intangible asset acquired in business combination? Again very important. Intangible asset can be recognized separately from goodwill if they are identifiable. Now this is one important practical issue also. Acquirer company may acquire another company which may have lot of brands, and this question they ask in the question also. They may have trademark, they may have a research division. Now this may not be appearing in the balance sheet of acquiree because self-generated brand, self-generated trademark, research expenses are not to be capitalized. Can it be capitalized in the books of acquirer? The answer is yes, if they are identifiable. Identifiable means separable. Identifiable means separable. Separable means they can be sold, rented and exchanged. But again there is a small exception. If suppose any right is in the nature of contractual or legal right, any right is contractual or legal right, a contractual or legal right may not be sold, rented or exchanged. Example, government license, then also it will be treated as separately identifiable. In other cases you have to apply the test of separability. One more question they can ask you in the exam is in-house research of acquiree. Nowadays many companies are acquired because they have got some research division, research facility. Another company may take years to do so much of research, right? So therefore they may acquire the research division also, which may fulfill the definition of business. Can we recognize it as a separate asset? The answer is yes. It can be recognized as a separate asset if it can be sold separately. If it is capable of being sold separately, then any in-house research division will be treated as a separate intangible asset. After you have acquired it, you incur two types of expenditure: research, development. Subsequent research expenditure will be charged to P&L account. But development cost, if you fulfill the condition given in IND AS 38, then development cost will be capitalized. Recognition basis, future economic benefit should flow to the entity from such intangible and the cost can be measured reliably. So in that case we can account for in-house research expenditure acquired from acquiree. Now the next issue is on which we have got some question in study material and RTP, MTP also. Measurement period concept. Measurement period concept. Okay. So suppose date of acquisition. This concept many students don't know. Pay attention. Date of acquisition is suppose 1st January 2024. Year ending date is 31st March 24. 1 year of acquisition will get over on 31/12 say 25. 1 year is over. Now the standard says you have to take fair value on the date of acquisition. Theoretically looks easy, practically difficult because companies are huge. So you may not be able to get the fair value of all assets and all liabilities on the date of acquisition. So you can do provisional accounting here. you can take provisional figure here, and then the standard says if you are able to find out the fair value up to 31st March, which is the first year ending date, what will you do? Suppose you are not able to find out the fair value up to the first year ending date also, then you are given total 1 year time to find out the fair value and update your provisional figure. But if you are not able to find out the fair value even in 1 year time span, but you can find out the fair value after 1 year is over, what will be the accounting treatment? So these are the situation we are going to discuss on the date of acquisition, on the first year ending date, after completion of 12 months, on completion of 12 months, and then after that date. So first, case 1, information is fully available on the date of acquisition. Your life is simple. Most of your exam questions are on this basis only, that fair values are available on the date of acquisition. So we will apply fair value and do the accounting. But for a theoretical question, they can ask you that fair value is not available on the date of acquisition. Information is not available on the date of acquisition. We can't calculate fair value for every item on the date of acquisition. Then the standard says you can use provisional fair value and use it in the journal entry. So use provisional figure. After that, suppose by the balance sheet date, the information is obtained fully. So we have discussed the date, 1st January 24 date of acquisition, 31st March 24 information is fully available. So now you can update the figure of asset liability. When you will update the figure of asset and liability, possibly goodwill or capital reserve may change, and also deferred tax adjustment may take place. Non-controlling interest figure can also change. So all the consequential effect you have to give. Suppose you are not able to completely obtain the fair value by the first balance sheet date, then what will you do? You will disclose in the notes to account that fair value is based on provisional figure. Then after, suppose that first year ending is over, the standard gives you a total 12 months time from the date of acquisition. If you are able to obtain the information about fair value even within 12 months from the date of acquisition, then you are allowed to revise the fair value to the correct value. Accordingly, goodwill or gain on bargain purchase will change. Accordingly, deferred tax may change, and any consequential effect like depreciation can also arise. And the disclosure will be required in the upcoming balance sheet about this change. But suppose you are not able to obtain full information within 12 months from the date of acquisition, then I have to freeze the provisional figure. Now I can't change the provisional figure as per IND AS 103. Later on, after 12 months is over, you got the information, then IND AS 103 is not applicable, but IND AS 8, accounting for changes in accounting estimate, will become applicable. Under IND AS 8, you can make the changes. Now you are not allowed to change the goodwill or gain on bargain purchase. The DTA, DTL which you had recognized earlier in business combination, that will not change. Now the standard says, on which you had a question also in the class, new information is obtained which was not existing on the date of acquisition. If an information is not existing on the date of acquisition and about that some information was obtained later on, then such information may change fair value, but it is not covered by 103, it is covered by IND AS 8. So if information about a debtor that he will become insolvent is not available on the date of acquisition, after 10 months, suppose the debtor becomes insolvent, but that is not due to condition which existed on this date, it will not be treated as an adjustment under IND AS 103. It will be treated as change in estimate. So we have to only adjust those information which existed on the date of acquisition. When you are solving problem of business combination, then the issue of deferred tax asset and deferred tax liability will also arise. DTA detail is covered by another standard which is IND AS 12. First, very important, if any DTA or DTL is appearing in the books of acquiree, if any DTA or DTL is appearing in the books of acquiree, you will not consider those DTA or DTL. Then we will consider tax rate expected to apply on temporary differences. We will only consider that tax rate which is expected to apply. If the parent company A is in India, subsidiary is in USA, then we'll take the tax rate applicable to subsidiary, not the tax rate applicable to India, and we will compute temporary difference. As per IND AS 12, temporary difference is the difference between carrying amount and tax base. Tax base of an asset is equal to future deduction, and tax base of the liability is equal to carrying amount minus future deduction. This I am not discussing in detail today because that will require a separate standard in IND AS 12. Tax base of non-taxable assets is equal to their carrying amount. All this will be explained to you under IND AS 12. So this was about business combination accounting. Now we'll come to demerger accounting. Demerger problems are of two types. One is without common control and one is with common control. Common control means the person who was controlling before demerger continues to control after demerger. Continues to control after demerger. That is called common control. After this slide, we'll cover the common control also. Okay. So step number 1, in case of demerger without common control, nobody controls the resultant company also. Nobody controls the resultant company also. So now step number 1, first you check whether demerger exists or not. A demerger will exist if a new company is formed. Condition number 2, this new company will take over assets and liabilities of existing company. Consideration will be paid by the new company to the shareholders of existing company. Student have to note down, this is really very important we are discussing. So demerger, if it is demerger, then discuss this, otherwise not. New company will be formed, new company will take over the assets and liabilities of the demerged company, and the consideration is paid to the shareholders of the demerged company. So for example, if Reliance company demerges Jio and Jio issues shares to shareholders of Reliance, then this is demerger. This new company Jio will be called resultant company. This existing company Reliance is called demerged company. Then we have to check common control, very important for exam. Common control means the resultant company and demerged company effectively remain under control of the same party, control or joint control of the same party. Then it is a case of common control. We will apply appendix C of IND AS 103. If it is not common control, go to the step number 3. Go to step number 3. Accounting treatment when none of the shareholders control demerged company. No shareholder has more than 50%. So first of all, think from resultant company point of view. The resultant company means the new company. The new company is acquiring a business. The new company is acquiring a business. It will simply apply IND AS 103 business combination accounting. Sometimes they will ask you to pass entry in the books of old company also. Old company will treat it like a dividend distribution to its shareholder, because old company is transferring assets and liabilities to resultant company and which is issuing shares to the shareholder. So old company will treat it like a dividend distribution as given in IND AS 10 and IND AS 105. Now please remember, if you have compact book, then you highlight that reserve and share capital is not transferred, even though division wise share capital or reserve is given. To confuse you, they will give you two columns. One is Maxi Limited, second is Mini, and in Mini they will give you reserve also, but we are not going to transfer reserve or share capital. We are only going to transfer assets and liabilities. Now the next part, common control transaction. Now please remember, very important, it is an important carve-in. IFRS 3 does not deal with common control transaction. It is Indian creativity, because Indians are highly creative. Ask my friend, okay, Adani ji, he will tell you, I treat him as my friend. He may or may not treat me. That is a separate issue. So common control transaction means when the same entity or same set of person control or jointly control the two entities before also and after also. Then this is called common control transaction. That means effectively nothing has changed. The controller remains the same. The controller remains the same. So if A has got two subsidiaries B and C, so A is controlling B and C. Suppose they merge B and C. Now they will have two entities A and B. But earlier also A was controlling A, B and C. Now it is controlling B. So same resources are controlled by A. This is called common control transaction. Since the control has not changed, the accounting system is also designed in such a manner that you cannot have an impact on the balance sheet. You cannot have a major effect on the balance sheet. Otherwise, by doing all such transaction, you will be able to increase the value of your company, the net worth of your company, and you can increase the market value, and you can make fool of the investors. So such transaction should not be transitory. Transitory means it should not be a part of acquisition and common control in nature. This I will explain later. Suppose a transaction comes under common control transaction. What about the accounting entries? Very important. This is similar to amalgamation in the nature of merger in your intermediate AS 14. Asset liability reserve from transferee company will be transferred at book value and difference will be recorded in capital reserve. So all items, asset, liability and reserve will be recorded at book value. If any consideration is receivable, then this should also be recorded. So I'll give you a set of entries not given in your institute study material. Pay attention. Two companies are there, okay, A and B, but the transaction falls under common control transaction. So in the books of B, that is the seller company, they have to remove from their books liabilities debit. They have to remove from the book reserve and surplus debit at book value, buyer company account debit, any agreed consideration to asset account at book value. So there can be some difference here. That difference will be adjusted in capital reserve, not in goodwill. That difference will be adjusted in capital reserve, not in goodwill, because you are not acquiring a business, you are selling a company, so goodwill will not arise, and then you will receive the consideration cash or investment account debit to buyer's company account. Then in the books of buyer company, very important, they will also record at book value, asset account debit at book value, to liabilities account book value, to reserve and surplus book value, to vendor company purchase consideration payable. Any difference is adjusted in capital reserve, not in goodwill, because this is common control transaction. And then you will make payment to the vendor. The entry will be vendor account debit to share capital account to cash or bank account. This method of accounting in common control transaction is called pooling of interest method. Example of common control transaction: merging of subsidiary with the parent. And second example is, which I had given you, merging of one subsidiary with another subsidiary. So dear student, I have made a very useful summary of pooling of interest method. You can get two types of question here. One is question on demerger and question other than demerger. You will be asked entries in the books of seller, you will be asked entries in the books of buyer. So in the books of seller, if it is demerger, the entry will be transfer assets and liabilities. In case of demerger, please note, demerger, it is one company, a division does not have reserve. Do not transfer reserve in demerger. Do not transfer reserve in case of demerger. No consideration is received by the seller. The consideration is received by the shareholder and the difference is adjusted in capital reserve. But if it is a problem of common control other than demerger, it means a subsidiary is merged with another subsidiary, then the selling company will transfer asset, liability and reserve. Consideration receivable entry will be passed, difference adjusted in capital reserve. What about buyer? If it is a case of demerger in common control transaction, they will record asset and liabilities, but they will not record reserve because a division does not have reserve on its own. Consideration payable to members will be recorded. Any difference will be adjusted in capital reserve. And if it is any other case, highly tested in the exam, both situation, highly tested, you can take a snapshot and keep it in your notebook. So if it is other case, you will record asset, liability and reserve, consideration payable is recorded and capital reserve is recorded as difference. Do not record goodwill. Now this is highly tested in the exam. The institute gives you question like this: there are two companies A and B. A new company AB is formed, but A has control previously over B and now over AB. So this may be a common merger. Okay. So legal acquirer and accounting acquirer will be different. In the eyes of law, A is acquirer, legal acquirer. But for accounting purpose, B is acquirer, whom we will call accounting acquirer. Whom we will call accounting acquirer. So how do you identify whether it is a case of reverse acquisition or not? This is one small challenge before the student in the exam, and last 4 or 5 years or 3-4 years, at least 3 to 4 times they have asked question on reverse acquisition. Sometimes it is explicitly mentioned in the question that it is a case of reverse acquisition. Enjoy. Please excuse me for a minute. Sometimes question will mention reverse acquisition. Sometimes they will be giving you some hint like small entity takes over a larger entity. But we as a student, we will do this calculation if nothing is given, that who holds higher number of shares in the post combined entity. I will calculate the number of shares held by legal acquirer in the merged entity. I will calculate the number of share held by legal acquiree in the merged entity. Suppose this is 40% and this is 60%. Suppose in the merged entity this is the respective shareholding. If the legal acquiree is holding more share in the merged entity, then that will be called accounting acquirer. So this will become accounting acquirer, and we have to do the accounting as if this entity has acquired this other entity. So you have to think very differently. So the one who holds larger proportion of share, that entity will be treated as accounting acquirer. So how to do the accounting? Once you are sure that it is a case of reverse acquisition, then pass the following entries. Before passing the following entries, make the balance nil of all the ledger balances of legal acquirer. Entries will be passed in the books of legal acquirer, but you have to assume that we are passing entry in the books of accounting acquirer. So in the books of legal acquirer, first you make balance of all the ledger 0. How do you make the balance 0? Assets will be credited at book value, liabilities will be debited, reserve will be debited, share capital will be debited at book value. So make the balance 0. Now you will take the asset and liabilities of the accounting acquirer at book values. You will take the asset and liabilities of accounting acquirer at book value. Sundry asset debit at book value, liabilities credit at book value, reserve credit at book value, and share capital at book value. So basically you are going to bring all asset, liability, reserve, share capital of the accounting acquirer at book value, and then you will calculate PC. It is always equal to fair value of the accounting acquiree. Any consideration given in question will be ignored. Now you are going to record asset, liability, reserve, asset and liabilities of the accounting acquiree or legal acquirer at fair value. Asset account debit at fair value, liabilities at fair value to vendor purchase consideration. Any difference will be adjusted in goodwill or capital reserve. Vendor account debit, purchase consideration, this figure, to share capital, to securities premium. So this is how the entry will be done. If the question specifies new number of shares in legal acquirer, if the question gives you new number of shares in legal acquirer, then do not recognize share premium in the above entry. Then don't recognize share premium in this entry. If the number of shares of legal acquirer are given, rather you make a change in the paid up value of the share. So paid up value per share will be total share capital divided by total number of share. If the question does not give you any limit on the number of share, then assume old paid value and fair value of share. Assume old paid value and fair value of share. Number of share to be issued will be, in case of reverse acquisition, if the institute does not give you number of share, then the number of share issued will be purchase consideration divided by fair value of accounting acquirer. Very important. In one or two exams, student who have appeared will remember this question was asked in a reverse acquisition. Now the last part is EPS in case of reverse acquisition. A, B. A is accounting acquirer. B is accounting acquiree. You will consider number of shares of accounting acquirer from the beginning of the year, and you will consider the number of share of accounting acquiree from the date of acquisition, and here you will take it from the beginning for the purpose of calculating weighted average number of shares. So dear student, this was a presentation on IND 103. You can purchase this book called Financial Reporting Compact Book, available on website vinod.in, where the same presentation is there and very good for last minute revision. For numerical question, you can purchase this compiler book, which contains question and answer from study material, all RTP, all MTP, all past exam, and some good reference books also. In addition to that, I have prepared one book called Class Note with Solution book. This book is one of the best books in the country on financial reporting. It contains theory and problem, topic wise, concept wise, and the way we solve the answer in the classroom step by step with all the notes and explanation written is covered in this FR Class Note with Solution. So student can purchase this book from our website. Right now we are offering it at 30% discount. So go to our website vinod.in and you can purchase FR Class Note with Solution. Those who have purchased video lecture can also purchase this book. They will get all the answer as solved in the class in the printed form. Very useful book for CA student also, CMA student also, and student preparing for any exam which requires the knowledge of IND AS or IFRS. So thank you very much for watching this video lecture. I am really grateful to you. My only request is please subscribe to the channel AS Foundation. Any query you can message on WhatsApp number or email ID. For more details you can go to website vinod.in. I wish you all the best for the student appearing in this coming exam or the next exam. Thank you very much.